I want to get in. We're getting kind of close on time. I wanted to get into the longer term exit strategies that you have, and I don't mean necessarily exit, but long term strategies. You do a lot of value add, or mostly value add.
Yeah.
Let's look at the conventional financing once you've got these things stabilized and ready to go in your final financing. Are you seeing any changes in financing right now? I know rates are really low and they have been for a while. Are you seeing any pullback on the LTVs or anything like that?
On the large scale multifamily side, at this point in time, it's still, kind of really a big hunger and a big appetite for the loans. And so, we're still seeing very strong, 80% loan to value, or even on acquisition loan to cost. Again, now there are debt service coverage constraints, in terms of that. But 3.5 to 4.25 rates, depending on what the situation is of the property.
That's free money.
For sure. I mean, like, good Lord, if you can get we're doing a deal, I think it's tracking at 365 right now. Good Lord, that's, a nudge above historic inflation, right? That's free money, realistically. And, so for us, we are definitely about executing the value add plan. And, like yesterday when I was at the due diligence at the property, and value add to me is how can I create a better quality of life for the people that live there? Mm-hmm. And because by doing that, it's going to create greater value for us. And so we're at it's a multi-site location about 1 mile apart, and one location, it's an entire city block, things like 14 buildings, 33 units, real nice.
Wow.
But there was majority 1 bedrooms, and out of the, whatever it was, I think 30 of them didn't have washer dryer. So, but I identified an area there where we could build on for about $24,000 ish, a washer dryer facility there, right? So that's the kind of thing that creates real value, not just also renovating the units and making them nicer, but then creating better amenities and better livability there. And, by doing that, we've increased the value. Now we've got more to work with if we wanted to refinance and keep the property for a longer term on the cash flow, which can be an option that we execute, or if we're then selling it, it's you've got a built-in increase of value because of the real work you've done. And, again, I go back to the doing the right thing over a long period of time. It's that execution of a plan for us usually takes, 12 to 18 to 24 months, depending on, renovating units on the turn. We do a lot of that, the laundry room, outside stuff all in the first, 3 to 6 months. But, that's the biggest part is are you really adding value and improving the community? Because then now you've got multiple exit. Even if rates move up or even cap rates, go up, I doubt that happens in the near term, but that you've got such an increase of value that you can easily still refinance out, pay out your existing debt, pay out your existing equity capital, and still operate on a cash flow basis. So, and again, goes back to Bill, what you said about multiple exits, right? We look at that, we could sell the property or we can refinance. Strategy part, if rates go up, but we've increased the value by this much, we can still refinance. And, so we're very much so able to sleep very good at night because we've got the bases covered.
That's awesome.